Welcome to China Focus. I'm Shelley Zhang. Now, the question everyone was asking at the end of last year is what was going to happen to China's growth numbers? Well, the numbers for 2012 are in, and they tell a surprisingly positive story. Today, here to talk about this, we have author of The Coming Collapse of China and Forbes columnist Gordon Chang. So, Gordon, when you were here last year on the show, you were saying, well, China's in for a hard landing, but the fourth quarter numbers came up and they said, well, growth is at 7.9% for the year. So what do you think? Were you surprised at that?
Well, I think the important word is surprising because those numbers really do not correspond with reality. They said that the growth for 2012 was 7.8%. I don't think so. I think that it was much lower, probably somewhere around 3.8%. By far the most reliable indicator of Chinese economic activity is electricity. Electricity production increased by 4.52% in 2012. And because GDP growth is about 85% of electricity, that makes it about 3.8%. And that's also consistent with manufacturing surveys, price indices, corporate results. So it clearly was not in the 7+ range. It was somewhere much, much lower.
But there was growth last year. It wasn't a zero.
There was growth, and then largely because of the government stimulus program. A lot of that growth is the result of state investment. You have the Go Cities, the high-speed rail lines to nowhere, and essentially, yes, it's technically gross domestic product, but it's economically useless. No other country would build these things. China is doing it because it needs to keep its growth rates up. But you take out economically useless production, you have a flatlining economy.
So let me ask you about some numbers you've been talking about in your Forbes column lately about trade. Now, the December trade numbers said, wow, we've skyrocketed 14.1% export growth. Now, what do you say to that?
Oh, it's nowhere near that. I mean, that just shocked the hell out of everybody because the consensus estimate was that growth of exports would be somewhere between 3 and 5%. What's going on here is that exporters are fabricating transactions to get export rebates. And so they submit all sorts of false documentation to get the rebates. That gets reported up to Beijing. And then they've got this inflated number. Now, at the Customs Bureau, they know what's going on, but they're not adjusting their numbers downward. So in December, export growth was not the 14.1%. It was probably somewhere in the 3 to 5 range. And that really makes the December fourth quarter GDP number, that's also inflated because it's been inflated by the export. So this has a knock-on effect.
So how you're saying that they want rebates, there's an incentive there are they pulling numbers out of the air? Are there actually exports going on, or what's going on there?
Yeah, there are exports, but what they're doing is they're inflating these transactions because the bigger value of the transactions, the more the rebates they get. And there's also some other types of transactions where people have a motive because of Chinese rules to exaggerate in one way or another. So these trade numbers, which once were thought to be absolutely reliable, now really are not reliable at all.
The trade numbers seem to have done a weird roller coaster at the end of the last quarter, too. They were high for September, October, dipped dramatically in November, and then skyrocketed back up in December.
Right. It is very interesting. And also, before September, you had low export growth. So essentially what you've got are some very abnormal months. And, anything is possible in China, but it's really unlikely that they had this big spike upwards. And I think that what we're going to see going forward in the first quarter of this year is that export growth is going to be much lower. There's still this incentive to try to get the export rebates, but I think that they cannot continue this.
So the way you're talking about it seems like it's not like a concerted effort to bump the number up, but a kind of self-interest for these companies to get these rebates or incentives?
Right, that's for exports. But the GDP numbers have been bumped upwards for political reasons because they could not show growth in the 3 to 4% range. That would just stun the international community. There would be a loss of confidence in China, so they cannot tell the truth about where their economy is growing. But you look at these underlying indicators, it just cannot be used to justify a 7.8% growth for 2012. And I think that's really going to be a problem because we're going to see going forward, these numbers are going to come down. They have this fourth quarter recovery. It might continue a quarter or two, but it can't for very much longer. And the reason is they built up all this debt in the Chinese system. Eventually, there's got to be some reconciliation. And when that happens, we're going to see growth rates come down dramatically.
Well, I want to talk about the impact of these numbers on kind of the world economy because, the trade numbers, when they go up, everybody seems to think, okay, well, the Chinese economy is recovering. There was an LA Times article where they're like, oh, well, this shows that the recovery is broadening because of the trade, the export numbers are going up. Like, what kind of effect is this having on other countries? And if these numbers are in fact inflated, is there something that's going to be detrimental?
Well, the first thing that happens is that these numbers, especially the export number for December, it moved global commodity markets as well as equity markets. And of course, it had an effect on the renminbi's value as well. So clearly, this is market-sensitive data. It is driving markets, and it's not true. Also, I think that's true to a lesser extent with the GDP numbers. They, of course, also are reflected in markets when people say China's doing well. So you have this knock-on effect. But clearly, when you start looking at the underlying data, when you get really involved in the weeds, you see that there's just things do not compute.
So what would you look at? You talk about underlying data. What would you look at to see if the export numbers are inflated?
Well, you have to check numbers with other countries. So, for instance, Beijing said that in 2012, China's exports to South Korea went up like 5.7%. But the South Koreans say that their imports from China declined by 6.8%. Obviously, one of these countries is not telling the truth, and that's the problem there. So you can do the cross-checking, but the cross-checking occurs much later because not everybody reports as quickly as China. And by the time you actually do the cross-checking, the markets have moved on.
But there's not something you could really correct for.
No, you can't correct for. But I think that what we're going to see as the problems in China become more evident, you're going to have analysts pay much more attention to the discrepancies in these numbers, because when you have China reporting these big exports and other countries reporting declining imports from China, people know that there just cannot be right.
Well, let me ask about a specific, I'm going to take a little turn here into Japan and China. Now, trade between the two countries fell about 3.9% last year, and people are saying it's because of the conflict in the East China Sea over the Diaoyu Islands, the Senkaku Islands, between Japan and China. Do you think that's having an effect? Yeah,
it's certainly having an effect, because in September of last year, Beijing was trying to use trade as a means of pressuring the Chinese, and so they did all sorts of things, which really hurt economic relations between the two countries. And we sort of saw that the Japanese reacting, because Nissan, for instance, at the end of October announced this big project for Thailand, I believe, which normally would have gone to China.
Right.
So we're seeing Japanese companies start to redirect their flow of investment out of China. And they've really got to protect themselves, because they need to have an alternative, because they are subject to political pressure. This is not the first time that this happened with Japan. So you go back to September 2010, China imposes this export ban on rare earth minerals to Japan, and it also imposed bans on the United States and the European Union. So clearly the Chinese are thinking about how to use their economic might to obtain geopolitical goals. As a matter of fact, at the end of last year, the Ministry of Foreign Affairs opened up a department on international economy specifically for the purpose of trying to use leverage on other countries. So we're going to see more and more countries worry about this, because they realize that economic relations with China are not just about economics, they're also about politics.
So do you think these countries are going to do what Japan's doing, to attempt to diversify, or is it kind of too late to protect your assets when you're kind of all in China already?
Yeah, well, we saw foreign direct investment fall last year, but that's partly, I think, or mostly due to just economic considerations, because China is not really the manufacturing platform that it once was, with wage rates going up, environmental rules actually being enforced now for the first time. And so a lot of what made China a very attractive place for manufacturing, and especially low-cost manufacturing, just no longer exists. So, for instance, we see now Walmart's house brand, George, for garments, used to be all made in China. Now it's all made in Bangladesh. And other manufacturers, other stores are doing the same thing, largely because China is just not a good place for low-cost manufacturing.
So Just to go back to the Senkaku Diaoyu Islands conflict, do you think that there's actually a chance that Japan and China will kind of get into an armed conflict about this, or do you think they'll just escalate it but not really go all out on the issue?
I mean, it's really worrying because we've seen all of these Chinese incursions into Japanese territorial waters, and now the Chinese are actually violating Japanese airspace with these incursions as well. I'm concerned, especially with all this war talk in Beijing, that it will just get out of control. We all hope that this is just bluster, but the law of averages says that one of these incidents will go wrong, and that's what we're going to really be concerned about, because the possibility of conflict between China and Japan is no longer negligible.
So they're really bound up together, though, these two countries, even though they have a lot of conflicts over this territorial dispute. Economically, they rely on each other. I mean, are we looking at something that's going to kind of snowball into the larger economy over this Senkaku Islands?
Yeah, I think that it will affect the Chinese economy. Any sort of conflict or even just disruption in the East China Sea is going to really send ripples throughout the international community. You remember in 1914, everyone said there wouldn't be war in Europe because all these countries were so closely integrated economically. Well, that theory didn't work then, and I think we could see the same dynamic this time around.
I mean, do we really have to look at something that seriously? Like, you're talking about the start of World War I here.
You never really know. And the problem is that the Chinese state right now is unappeasable. It is using forceful tactics, is trying to upset the status quo, and the Japanese are just not going to back down. So clearly we got a problem here. Also, we have a mutual defense treaty with Japan that covers the Senkaku Islands, so there is a possibility for entanglement of other countries as well.
All right. Well, thank you, Gordon, for coming on and talking about these issues with us today.
Well, thank you so much.
And thank you for watching. For more on this and other issues in China, join us at ntd.tv.